Hello, I'm Mark Dunn, editor of investment magazine Portfolio Institutional, and welcome to the latest in our series of digital roundtables. This particular discussion focuses on equities. Now, equities are a cornerstone of institutional portfolios. In fact, I've never seen a pension scheme that is not exposed to the asset class in some form, and of course, it's a global opportunity. But as final salary schemes are maturing, they appear to be moving out of growth stocks in favour of more income-generating assets. Indeed, the average UK pension scheme allocation to equities is 18%. And according to Mercer, in 2010, that figure was 50%. And then, of course, in 2020, volatility hit equity markets across the world as COVID took hold. So it'll be interesting to see what happened next. And to find out, we've put together a panel of experts. Let's meet them. Duncan, can you start off with introductions, please?
Morning. Yes, thanks for having me. My name's Duncan Wilshire. I'm a trustee director at 2020 Trustees. I sit on a number of schemes ranging from very small to very large, and in a former life I was an investment consultant.
Gotcha. Is it just DB that you focus on, or is it a mixture of DB, DC?
Predominantly DB, but a little bit of DC, and invariably I end up helping my colleagues internally on all sorts of things. So actually it extends a little bit outside of pensions sometimes as well.
Gotcha. Okay, thank you, Duncan. Neil Mason.
Hi, morning, Mark. It's Neil. I'm head of pensions for the Surrey County Council Pensions Fund, valued about 5 billion, around about 120,000 members and just over 300 employers. I'm also on the policy board for the PLSA, and I'm on the local board for the London Borough of Hounslow Pension Scheme.
Gotcha. Thank you, Neil. Peter.
Hi, Mark. Peter Abrahams. I'm an investment consultant at LCP. I advise a number of schemes, large and small, with corporate or charity parents, and all at different stages in their long-term journey plans. I'm also involved in investment research at LCP with equity and fixed income responsibilities. Thank you, Peter.
Thank you. Neil Godin.
Hi, thanks, Mark. I'm Neil Godin. I work for Artemis on the recently formed Positive Impact team. Our fund is called the Artemis Positive Future Fund. I used to work at Keynes Capital, running various equity global fund mandates as well. The most best performing one of which was the Keynes Global Sustainable Fund. So a lot of experience running impact, ESG, sustainable type funds. Thanks.
Gotcha. Thank you, Neil. And last but not least, Anthony.
Morning, Mark. Morning, everyone. It's great to be here. My name is Anthony Petalis, and I'm a portfolio manager at Border to Coast, which is the investment arm created by our 11 local government pension funds, including Surrey and Neil, in implementing their strategic allocations. My primary responsibility is the oversight and management of the external managed high alpha strategies. We're currently responsible for about 10 billion of assets under management. And this includes investing across global and regional equities, sterling investment grade, and the soon to be launched multi-asset credit fund.
Got you. Thank you very much for that, Anthony. I'm sure you'll agree, quite a diverse team, a panel here from across the value chain, from trustees to asset owners, asset managers and consultants. So should be a good conversation. And I think we'll start with yourself, if that's okay, Neil. Could you just give us a flavour of what's in your global equity portfolio? Neil Mason.
Yeah, that's great. Yeah, so I mean, we're talking about the allocations earlier, Mark. We're quite bullish on equities. We have a exposure of about 60% at the moment of our portfolio to equities, of which we'd have about 10% in the UK. The rest of it is broadly split across global mandates, but what we have tried to do is mix in our benchmarks so that we've not over allocated to market cap. So we've got some GDP cap in there, and we're quite bullish on emerging markets as well. So we've got about we will have, when we get to our total optimum asset allocation, around about 10% of the portfolio will be looking at emerging markets.
Okay. Thank you very much, Neil Mason. Anthony, Neil there said he's bullish on equities. What are you guys providing for your partner funds in terms of equities?
Well, we currently have two strategies. So one of them is global and UK strategy. And what we're trying to do is create a blend of various styles, as you would like to call them, to give them that diversified exposure to the various parts of the equity market. So it's a very diversified product. Obviously, we're trying to achieve that plus 2% net of fees outperformance. So they're highly concentrated, high tracking error strategies. But that's kind of our fundamental belief, not trying to be biased towards one single factor, one single style across the equity spectrum.
Okay. We'll get to that later, I'm sure. Duncan, when I started my introduction there, I mentioned some research in terms of average allocations to equities in the UK are falling and moving more into income generating assets like bonds or property. Is this what you're seeing with the schemes you work with? Are they pulling more out of equities?
Yes, I would say the picture you painted was pretty accurate. I think the difference is there's probably a divergence of approaches. So there are some schemes that have continued to hold high allocations to equity, and maybe that's because they're bullish on equity, like Neil. Maybe they need that additional return, but can't deal with some of the complexity of some of the other assets that they could think about. Or it's just that's what they've been doing for years and years, and kind of why change it? Actually, I think what I'm seeing most, or what I'm seeing the large proportion of schemes doing, is moving to, like you say, more income generating portfolios. So a lot more use of credit within those portfolios. Or those schemes who've had a really good experience over the last few years, they've had those really positive equity returns. They've had a high hedge, and actually they're closer to buyout than they thought they were, or they were a few years ago. And they have, again, they're mostly in credit. In those last two examples, I think some people hold, I would say, kind of anywhere between 5, 10, 15% in equity, maybe still, just as a hedge potentially against esoteric risks. But yeah, direction of travel is definitely towards credit.
Okay, thank you for that. Neil Godin, just here, their direction of travel is moving towards credit, but equities are still an important part of institutional portfolios, aren't they?
I hope so. I mean, it's very nice to hear some positive comments around equities. When you read the headlines recently and over the last couple of years, you'd think, you know, they were done for. And for us, they still make an extremely good long-term investment, you know, over any sort of time horizon that's not 3 months or any sort of scare around inflation. Equities are a great investment. We love equities. We think they're a great long-term view. It's interesting to hear sort of the hedge call, because we talk a lot about our portfolio, which is very exposed to high growth companies that can notionally look expensive until you dig a bit deeper, are a great hedge against traditional equities and, you know, incumbents and all the change that's going on in the world. So very much chimes with the way we think about the market, certainly, and where our specialism is.
Gotcha. So thank you, Neil. Peter, the last word on this particular section to you. What kind of conversations are you having with your clients about equities?
So this year, certainly, a lot of the pension schemes that I advise have seen improvements in their funding levels. That's due to a combination of rising interest rates and also good performance from their growth assets. So we have been having conversations about whether there's an opportunity to take some risk off the table. So whether it's possible to trim some equity allocations. But again, I recognise that divergence that Duncan talks about, where some schemes are more eager to do that than others. And also we have to seek the views of the sponsoring employer, and some sponsors are not so keen to reduce equity allocations if it means that perhaps in the future the scheme might ask for more contributions.
Okay, Peter, thank you. Neil Mason, we'll start with you. Growth, value, momentum. What are you favouring at the moment? You say you're very bullish. What's hot for you at the moment?
I suppose, well, first of all, I probably ought to say there's probably some good context to our bullishness, and it's probably worth mentioning that we are an open scheme, and we do have positive cash flow moving into 2024, 2025. So there is a reason we can afford to be bullish in that we don't have that issue of buyout. So probably ought to caveat that we're reckless in our asset allocation. From the point of view of where we see the value, I think probably we have seen opportunities in. If you wanted me to make one particular call, we probably have seen there it is in value stocks that we see value. But it's sort of turning to the point that Anthony made earlier. I think where we see our investment strategy is providing a combination of different approaches so that we've got a risk budget arranged in there, and we can provide returns irrespective of particular fads that might come across any particular time. So I'd say if you wanted me to make one, I would still say that there is value, particularly in. I mean, we've seen in the UK. I think the UK is slightly undervalued at the moment, but long term, I think we're probably emerging market as well.
Gotcha. Okay, thank you very much. Duncan, there talks about emerging markets, UK undervalued, looking at value stocks. With the conversations you're having with your schemes, what are they interested in? What approach are they taking?
Yeah, so it probably won't surprise you that there's a diversification of approaches. I don't think that there are any strong views as to, you talked about value, growth, momentum, where things are going to go over the next few years. I think if there was a theme, it would probably be more about how do we integrate ESG into our equity portfolio than debating growth versus value or momentum or whatever else. So yeah, and then again, I spoke about the divergence of approaches where that allocation is coming down materially. Passive does make up a fair chunk of that, just because as it decreases its importance in everything else, and making an extra 1 or 2% on a very small allocation sort of makes less sense in lots of those cases. So yeah, it's diverse, to be honest. All sorts of things happening.
Okay, got you. And Peter, when you're speaking with your clients, so what strategies are they favouring?
I've got a mix of clients, some who have benefited from the rally that growth stocks have seen over 2020, and others who've been a bit stung by general underperformance of value strategies over recent years. What I would say is there is a bit of a theme of moving away from strategies with a specific growth or value tilt. So looking for something that's maybe a little bit all weather, and that includes both clients that have done very well from a growth strategy and have thought, well, actually, maybe I want to bank some of those gains and not have something that's quite so much reliant on one style doing well. And also those investors who haven't benefited from value doing so well.
Okay, thank you, Peter. Anthony, we saw lots of volatility in stock markets around the world last year. Have investors maybe missed the boat in terms of picking up a few bargains if they're looking at markets now?
I think there's always bargains in equity markets, irrespective of what's happened. I mean, we did have a very low base effect. Just going back to a little bit of the point about growth of value, because this feeds into it. I think it's interesting because if you look at the last 8 months, there's been a clear rotation from growth to value. However, this is probably due to the COVID impact on cyclical stocks and the low starting base effect, which goes to your point about whether there's any bargains. So yes, we've seen that COVID impact kind of materialize, and we also have seen kind of big rotation to this. So it's less likely you will find stocks opportunities in that space from that cyclical impact we've seen with COVID. Now, when you look at slightly longer term performance numbers, I think it's been mentioned, it's certainly clear that growth investing has dominated performance, and that's over 2020, but also over the last 3 years, and even if you extend back to the last 10 years. Now, having said that, from our perspective, I think I said at the beginning, it's neither about pure value or growth, and we actually find these abstract labels kind of too generic and actually quite dangerous, to be honest. We don't feel that a good investment can be confined to a single descriptive category, whether that's a valuation, multiple, or earnings growth. There are certainly companies within the value bucket, which we call them bargains that investors should avoid, which we wouldn't call bargains, sorry, but which call them value traps that investors should avoid at all costs, either because they're operating in structurally declining industries, or as Duncan kind of mentioned, there's serious ESG concerns, which then translates to higher financial risks. On the flip side, though, you can't ignore valuation when you're paying for growth, and there isn't an infinite price investors should be willing to pay just because the company is growing faster than the market. Now, it's obviously the value dispersion that we've seen between the average value growth stock and the average value stock is at all-time highs. So I would agree with you that the probability in finding bargains or finding something more attractive in the value bucket is probably slightly higher than the growth bucket. Now, again, as I said, we still think there are many wonderful businesses in the growth bucket that operate in structurally growing industries with very strong growth runways out of them. And as long-term investors, we do not want to trade the strategic exposure irrespective of which styles in favor currently in the markets.
Thank you. Neil Mason, you mentioned there the UK is undervalued, but also you mentioned there that you're very much looking towards the emerging markets. I mean, what markets within the emerging markets are standing out for you guys at the moment?
Yeah, I mean, that's I'm tempted to be drawn on China here a little bit, but I'm going to avoid that banana skin, because of talking to Neil's earlier point, and Duncan mentioned it as well. We have, while we are bullish on emerging markets, we have significant ESG concerns in that area. So I'm going to temper my response to that. So I was probably, South Asia is one of the areas we like, but I would say we'd need to caveat it. There's a lot of work to be done on the ESG space there, and it's something that was an ongoing concern for us as asset managers.
Okay, thanks. Neil Godin, how are you guys managing valuation risk?
Yeah, I mean, I would echo everything Anthony said up front. You know, we specialise in growth stocks, but that so oversimplifies the discussion in so many ways that it's just absolutely nuts. We essentially choose to specialise in positive impact stocks with high growth characteristics because we can focus on one part of the market and get to know that part of the market really well. That doesn't mean that there isn't good value in value stocks. That doesn't mean there isn't times when it's better to be in value over growth, etc. We believe over the long term that it's much more about picking stocks than it is about picking a theme, and talking about value versus growth is a sort of much done thing which is overestimated. What you do see is periods like 2020 and 2021 when the valuation gap got really expensive for growth, and now it's flipped back to pretty close to the norms. I wouldn't call it, you know, significantly out after this rally in cyclicals from where it was, and is less of a concern. And it may well go to the point where value looks quite expensive. You know, value keeps going on. But if you focus on the longer term, that doesn't really matter. What really matters is the stocks you own, are they misvalued? And that doesn't mean they're value stocks. That doesn't mean they're growth stocks. That means you are finding an edge in the way you are looking at that stock that makes you believe that stock is undervalued. It can start on a PE of 100 or not have a PE because it's negative earning, or it can start on a PE of 3 and it can be either overvalued or undervalued, depending on the research you do.
Gotcha. Okay. Duncan, do you feel that equities are overvalued at the moment?
Yeah, so I mean, if you look back over the last few years, everybody was saying, surely they can't go any higher, surely they can't go any higher. And the practical reality is that nobody ever really knows, right? Like best guesses and all that sort of stuff, and then something you don't expect happens. So are they overvalued? Can they go higher? I think chances are that they will continue to rise in value. I think for me, it's just about having a balance of risks. So, you know, equities have paid out over history and have continued to do so. And so for all the good reasons we've talked about here, you need to make sure that you are part of that, but it's about just right sizing it. And I think that those are the conversations that trustees are having, that are more important than, you know, some of the very detailed points. These detailed points we're talking about actually are best had between Neil and Anthony, etc., rather than at the trustee level for lots of boards. Not all boards, some boards have that sophistication and can deal with it, but for the majority of schemes, they're probably best set about talking about setting the right sort of level of risk.
Okay. Thank you very much, Duncan. Peter, we're being told by market watchers, and Duncan just touched on it there, about the valuations, especially of US tech stocks, maybe looking a little hot. Should index investors be worried?
It's a very good question. Certainly, there's been a lot of press on their valuations in recent years. And the example that's often given to say that you shouldn't be worried about valuations of US tech stock is Amazon. So in the late 90s, early 2000s, it was always viewed as being very overvalued. People were thinking of it as an online bookseller that was branching out into some other retail lines. And nowadays, obviously, it's an absolutely massive conglomerate with lots of different business lines, including quite a lot of its revenue coming from cloud computing. Yes. So the argument sort of goes, you can't necessarily just value these businesses based on what they're doing today, and assuming that those business lines grow in value. You also have to think about these really clever ideas that they might come up with that maybe don't even exist today. And that sort of thinking does support a lot of US tech stock valuations. Of course, not every stock is going to be in Amazon. Some of them are going to develop these fantastic new business lines and some of them aren't. If you're an index investor, you have to own them all, and you have to own them all in the proportions that the market assigns to them. So I think it does make an argument for a good active manager who can make those kind of decisions and decide whether something is fairly valued or not.
Gotcha. Okay, thank you, Peter. Another issue that's a big talking point at the moment is inflation. Inflation fears have expanded, continue to rise. Does anybody want to come in and make a comment about whether they think that's going to be a big issue, how that's going to affect the markets? Anthony, come in.
Yeah, it's anyone's guess. I think we're starting to see signs where inflation is becoming an issue. Now, I think the $1 million or £1 million question is whether this is a transitory effect or a long-term effect. Obviously, COVID has created a new base effect. So you're starting at a very low base effect. So any numbers that we see in terms of CPI and RPIs and all that kind of stuff from an inflation perspective is a lot higher than you would expect. However, you know, again, as I said, the question is whether this is a sustainable transitory effect or is it to come on a long-term effect. And I feel at the moment, I am probably in the former camp, which is probably a transitory effect. And that's because we haven't solved two of the key issues that we've had the last 10 years. And that's productivity and also demographics. You know, especially in kind of developed markets, we're seeing aging population and we're seeing quite low productivity. So if these two key drivers to long-term economic growth are not there, I kind of struggle to see how this could be a more sustained impact. Now, I do want to note the other thing. One of the key differences that COVID has brought to the table is we're seeing a lot more fiscal stimulus than we've probably seen the last 10 years. And we're actually seeing a slightly different monetary policies from central banks in terms of not just giving money to banks, but actually giving money to people's hands. So we're seeing the broad money supplies going across the globe, going higher. So I think these are kind of two nuances that are kind of different to what we probably experienced in the last quantitative easing that we've seen across the globe. But again, I don't think they're enough to offset, as I said, the headwinds in terms of productivity and demographics, to be honest.
Okay, thank you, Anthony. Everyone agree with Anthony? Does anybody else have an opposing view to that?
All I would add is, I mean, the demographics one is definitely clear. You know, the demographics aren't changing. If anything, COVID will marginally make them worse, but it takes 50 years to change demographics. And for 10 years, we've spoken about that. And then we get to a bit of inflation clearly driven by COVID, and suddenly we forget about the demographics argument. The productivity one's actually interesting because you could argue that COVID is actually helping to improve productivity. I just don't believe it's inflationary productivity. It's probably deflationary because things like Zoom and all these, you know, software devices make us more productive, but we don't move. So we're not spending any money or as much money anyway. So, you know, I both 100% agree with Anthony and slightly nuance it as well.
Thank you, Neil. And if no one else has anything else to add on inflation,
I might just quickly come in as that there is an assumption that inflation is necessarily a bad thing. I don't know if that's something that's we're still hang back to the 70s and the economic theories of the day. I think a little bit of economic of inflation isn't necessarily a bad thing, particularly if it affects wages.
Okay, good. I'll tell you something else not a bad thing. Dividends. And they've been in short supply since COVID hit. A lot of companies have cancelled or reduced the level of payments. I mean, Neil Mason, when do you think that we're going to come back to a more sort of sustainable level of dividends? When do you see them coming back?
That's another $1,000 question, isn't it? Really, you're asking when we're sort of going to get through this COVID period and when we're going to get reasonably predictable cash flows and companies are going to get back on their feet. One would hope to see with if they. I think it's a lot of it. Again, it's been mentioned elsewhere the changes in government policy. If we continue along this sort of, dare I say, MMT view, then I think that will give stimulus to the economy and it will allow for companies to recover quicker than if we moved to more of the austerity type of narrative. So yeah, I would hope that sort of as we come out of lockdowns, as different economies start to build up again, that sort of next year we would start to see a return to some sort of dividend returns.
Thank you, Neil. Peter, when your clients sit there and say, so when are we going to see some dividends return? What's your reply to that?
So similar to Neil's opinion, but another thing I would add to that really is there has been some sort of bad press around the payment of dividends by some companies that have benefited from government policies during the COVID lockdowns. So we saw with some of the supermarkets that when they went to pay dividends to investors, where they had been in receipt of large amounts of government money, it was reported by the press as them paying taxpayers' money to shareholders. And I think there will be a little element of that will make boards a little bit cautious about the payment of dividends and how that will be viewed by the wider market.
Gotcha. Okay, then Duncan mentioned earlier ESG and how that's being used to build an equity portfolio. It's quite an interesting topic, of course. Neil Mason, could we start with you? I mean, how important is ESG to you when building a portfolio of equities?
It's absolutely fundamental. Our stakeholders demand it. Our residents, the Surrey residents, require us to have a view on that. It runs through our portfolio building and our discussions, as Anthony will be more than aware with our asset managers, whether or not we are trying to engage with companies to act in a certain way, or whether we're looking to tilt in some of the assets classes where we might be a passive owner. It runs throughout our business. We have at Surrey, we have an ambition to try and map our portfolio against the UN Sustainable Development Goals. We make positive decisions regarding that within our portfolio. So yeah, it's completely fundamental, Mark.
That's really good. And Anthony, what about you? What about your conversations with your partner funds? Are they demanding a bit to demonstrate how you're putting ESG into your equity funds?
Well, echoing to what Neil said, it's an absolute fundamental principle, and it's embedded in our culture. And I wouldn't expect this to be otherwise. And it's not just to what Neil said. I think it's across all of our partner funds that this is the case. Now, the way we view ESG, it probably falls under two broad categories. I think one is ESG is probably strongly correlated with financial risk, and therefore should be embedded in part in terms of the investment process. Mm-hmm. But we also think that the real added value through ESG is done through engagement rather than passing the count down to the next investor, which is often done through exclusion lists. And this is one of the reasons why we don't run those exclusion lists. We do need to see some sort of strong evidence in terms of more sustainable future. And actually, the way we implement ESG, if I may, is through our investment processes at 3 different stages. Mm-hmm. It's in terms of the manager selections and how integrated ESG is part of that of the manager's process. And then it has to do also with the idea generation, screening, research, due diligence, even portfolio positioning. But then overall, if you look at our portfolio construction process as well, when we're blending these strategies, we also do an overlay in terms of how does the portfolio look in terms of climate risk, corporate footprint, or ESG metric using external providers. And it might not come as a surprise that when you look at our high alpha strategies, and despite having quite a big allocation to value, our products have 50% reduction and more in certain cases in terms of the corporate footprint relative to the benchmark. So it's an absolutely fundamental principle, and it's something that we abide by.
Thank you very much, Anthony. And Duncan, I started off by saying you did mention ESG and it's core to some of the schemes you're working with. And tell us a little bit about how that's been implemented.
Yeah, so it's really difficult, is the honest truth. And that's because there's just a lot of conflicting information out there about a topic that is genuinely difficult and multifaceted in so many different ways. So what am I seeing? Well, clearly seeing investment through passive and tilting and those sorts of indices that have been created that people are aware of. But they're not perfect. There are lots of reasons why they don't do the full job. And hopefully they'll evolve and get better over time. But they're a good, helpful step in the right direction. I think the other side of it is active management, where, as Anthony's highlighted, you've kind of got more flexibility to do what you need to do as the investor. You can engage, you can properly threaten to exclude if you need to, etc. But actually, in my conversations with CFOs and the like, and investment managers, I think it's really difficult to turn the words that Anthony was saying into practical demonstration of what's actually going on. So CFOs are saying, actually, managers are not really challenging us on this. They send a letter to the CEO, who just passes it through to the CFO's desk, says, answer this, goes back, and that's kind of the end of it. And there are plenty of examples of that. I'm also going investment managers saying to me, well, actually, the investment consultants kind of do a similar thing. They just send an RFP and kind of that's the end of that. And so as the investor, as the asset owner, it's really difficult to know what is actually happening behind the scenes. I think things like the implementation statements and the like, where we're actually having to put forward practical examples of how this has been undertaken is really helpful in focusing everyone's minds. But yeah, it's tricky.
Thank you, Duncan. Thank you. Neil Godin, can you tell us a little bit about how your clients, our investors, are making environmental and social impacts in their equity portfolios?
Yeah, I mean, I would echo a lot of the points that have been made already in terms of, I mean, clearly, I manage a positive future fund, so it's going to be at the higher end of the scale of ESG by its very nature. And I think it's important to highlight that there is a scale and there is no right or wrong answer. So I think the only thing there clearly is a baseline where we shouldn't dip below in terms of ESG. But apart from that, it isn't wrong necessarily to own some of the stocks that need to get better. We choose not to do that. We choose to focus on stocks that we believe are trying to change the future. And our view behind that is kind of exclusionary lists have been around for 30 years. Not much has really changed, by not investing in them. And the same can also be said by investing in sort of the good quality companies that often many do. Things are getting incrementally better, but not materially better. So we focus on companies that we believe are clearly making that impact today or looking to make that impact in the future. So whether it's an environmental issue, whether it's a social issue, costs in the US healthcare system, is this product materially improving the health outcome for the patient and at a cheaper price than the traditional way of doing it? Is renewable energy, hydrogen, batteries helping to solve the issues of 1 in 5 people in 2018 dying through the burning of fossil fuels? You're looking at these specific issues and you're trying to solve them. That doesn't mean any of the other points are wrong either. They're all valid, but we think the best way to implement real change in the financial world today is to focus on companies trying to change the world. and change the world, with a focus just there. So our companies tend to be doing one thing, and you either believe it's impact or you don't. They either get it right or they don't. If they do, the share price will go multiple times higher and the impact on the world will be really positive. If they don't, they may shrivel away to zero. But that's the risk you want to take on, and you go back to the kind of Amazon, Netflix, Google point of before. You don't need to find many Amazons to run a really good portfolio.
Okay, it's interesting to talk about making an impact, but how are you measuring outcomes here for investors?
Yeah, I think it was Duncan who mentioned, or maybe Neil mentioned, the third-party screens. It's interesting for me. There's more than one way to run a income fund, but no one moans about the complications of running income funds, particularly, and it's the same for ESG funds. There's lots of different ways to do it. Personally, and for our team, we have problems with a lot of the third-party methodologies. They either seem to conflict with each other blatantly. You'll get stocks that an A on one and an E on the other, and you're like, well, I don't know what to do with that. Or they focus a lot on operational issues, which is understandable because you can measure things like, women on the board or diversity. That kind of stuff is easy. They don't tend to focus on the product so much. And just one of coverage often. We invest in companies that often aren't even covered or are very young, and they clearly do something really good, but they haven't got an environmental report, so they get a really bad score because they've got an environmental report, even though they're a renewables company that's clearly doing lots of good things. So they're not without their challenge. It's not without its challenge measuring stuff, but every month, every quarter that goes by, things get better. Companies are reporting more and more. We interact with the companies to try and get them to give us these type of reports, and most of the companies we invest in have a very strong ESG culture, so they're very keen to learn and understand what we expect from them. So all the time, it's improving. Our coverage of companies that do an ESG report goes up every 3, 6, 9 months that we go by. So there's lots to like in the sector from that perspective.
Yes. It's interesting about data like non-financial reporting, whether that be from the corporate itself or from third parties. How easy is it to get hold of this data, and how reliable is it?
As I said, not always that reliable. It's different. You need to be careful. You need to think about the way you use it. I see lots of sort of these impact calculators out there. I'm cautious on the data underlying them. I don't know how you manage some of these companies' CO2 emissions and, sort of initials and later ones, the impact of their products. It's very difficult, but that doesn't mean, and it's really important, that doesn't mean we should just give up. We should really understand our companies, speak to them, speak to peers, speak to experts, and try and understand what they're trying to do, challenge them on things like net zero, and keep it really stock specific and understand how they are having an impact. And we keep a lot of that sort of data ourselves from the companies. I guess I'm more cautious on the third party side of it, in terms of some of these numbers. I'm just not convinced that they're always correct. And I'm not convinced that it's always relevant to have a go at a software company for not having an environmental report. It's, British American Tobacco scores really highly on some of the ESG methodologies. Just nuts.
Okay. Anthony.
I would echo everything Neil said. I think the biggest issue I've got with a lot of the ESG data is backwards looking. So it doesn't capture any future opportunities. And I think this is where active management could really add value in a sense. Because if we think the future performance is generated by future cash flow and future risks rather than what's happened in the past, then having that eye into the future is, I think, it's quite crucial. And I think this is why I kind of mentioned that, yes, exclusion list in terms of structurally challenged and very unethical business models and industries. However, I think it's also, if we think it's a financial risk, it's also a reward or opportunity for investors to identify those businesses where these might be cyclical, they might change them, the management can do something about it, and that should reflect into the future price. So I think that's my primary concern with this ESG data, very backwards looking.
Okay. Thank you, Anthony. Peter, ESG non-financial metrics data easy to get hold of for you?
I would say, I mean, at the risk of sort of agreeing with everyone else on the call, it's not the most reliable data that's out there. Certainly some ESG risks you can find more reliable data than others, and the non-financial stuff. So I presume we're talking more about ethical exclusions here. You can look at sort of the proportion of a company's revenue that's generated from certain sources, and there are not just active managers that can do that, but there are indices that track that information. And that's probably about the most reliable you can get in terms of data that looks at more ethical factors.
Thank you much, Peter. Thank you. Neil Godin, how do you prove to your clients that you're serious about ESG and it's not just talk?
Yeah, I mean, I think if we talk about the wider market first for a second, I guess it is becoming more of an issue. You know, you're seeing lots of funds rebadged, you're seeing ESG becoming talked about by every single asset manager. And if I'm honest, some of them I believe and some of them I'm skeptical on. It may be that that's a natural human mistrust and the vast majority of it is really misplaced. It may be that that fear is correct. Only time will tell, because maybe everyone has got religion and ESG is the new standard and we will all use it because we've seen that it can add real value. All you can do individually is report in the right way, get people to understand, talk to clients and talk to companies you invest in, talk to your peers about how you do things, how you can improve things, what you believe in right and wrong. And really it comes down to some of the softer stuff for me around culture of the way you manage the money. And it's something we look at in our companies. Is one of the most important things we look for in a company is the culture. You cannot change the culture of a company very easily. Good companies from day one tend to stay good companies for a long time, and companies with the wrong type of culture tend to stay there. So if I was looking for a manager to manage my fund, which I'm not because I'm invested in my own fund, but if I was, I'd be looking at the culture of the manager first rather than what they may report and, you know, their snazzy little reporting package that may or may not be accurate.
Thank you. Duncan, and how does that compare to what you look for when someone sits in front of you and say, yeah, we do SG?
Yeah, so there are definitely instances of funds that have just had the word green inserted in it in a new refresh of it, and actually if you look at the portfolio, very little has changed. Again, maybe I'm in the cynical camp on some of this, but yeah, so I think what I'm looking to do on schemes is really just engage and make sure that it's something that's spoken about beyond just the selection exercise and meeting and whatever else, and it's not the last couple of pages in a deck if you see the manager or what have you. I think what I want to see is carbon metrics, for example. So again, they are not perfect at this point in time, and let's just accept it's not perfect, but let's just start putting that next to your portfolio return, benchmark return, and a carbon metric of some form, approximated, whatever it is, and let's start seeing that go down over time, if that's what you say is important in that portfolio. And if it's not going down, that's also okay. Let's have a conversation about why it's going up. Okay, we've invested in this security. Actually, we can see long term they've got a plan to address it. So it's not about like a stick to beat anyone with or anything, but let's just start putting some of these things front and center rather than the kind of old traditional just looking at quarterly performance necessarily. I think the other thing that I want to see is talk about some of the other aspects as well. So carbon, you know, getting to a point where there's some harmonization or consensus about kind of how we go about it, but let's start broadening the conversation into things like biodiversity as well, and kind of how are you thinking about biodiversity in the portfolio. And I just want to get this language into more of our meetings, basically.
Thank you, Duncan. Anthony, so when you're sitting opposite an equity manager and they're talking about ESG, what are you looking for?
I completely echo to what Duncan said. I think it's three key figures for me. It's evidence, reporting, and then transparency. So when we go into the managers, because we're very close to the stocks ourselves, we understand these companies very well as well. We have that edge into going to the meeting and having very specific questions. So when we talk about some sort of concerns to what Duncan said, I mean, yes, ESG data is not perfect, but it gives you an indication of what's happening, and it gives you some sort of a good base to have those conversations with. Then you go into the manager meeting, you've got that evidence, and you have those discussions, and you have the conversation with them. And what you're truly looking for is that evidence. You know, how have you implemented, how have you thought this ESG risk, and why did you invest in this kind of companies? And this is what we're actually doing, how we communicate to our partner funds and to Nino as well. You know, it's taking that and then showcasing to our partner funds, here's a carbon footprint metric. We know it's not perfect, but this is what we do. Here's, you know, which ones score the lowest in terms of ESG ratings, and here's the rationale why we hold those companies and what we expect this to happen. So as long as you have those three things, especially transparency, which is quite important, then I think you could get the message across that you're trying to implement this part of your process.
Good. Thank you, Anthony. And Neil Mason, anything different you look for there that we've not already heard?
I did want to go back to Duncan's point, which I think was really, really important, about that there are sort of more mature metrics, particularly in the carbon space. They're not perfect. We understand that carbon intensity measures, you know, it depends who you're talking to, doesn't it? But really, mentioning other areas that the S in ESG, we really welcomed the government consultation. We're interested in that. It's part of how we look as other metrics to manage our portfolios through. I suppose from the overall, it depends really whether we're talking about well, passive money or active money. We're in a position where we work with Anthony and his colleagues at Border to Coast, where we're in the trenches, as it were, when we're building the portfolios out. So we're contributing to the RFP process. It allows us that insight, and then we have to hold Anthony and his colleagues to account, and that's and we do as well as we can. As long despite him being a nice chap, we do make sure that we're getting that sort of key insights back from our asset managers.
Great. Okay. Thank you very much, Neil. We're into the last 10 minutes now. So what I'd like to end just with a look into the future to see what's coming up next. So I'd like to go on each of you and just get your thoughts on what you're expecting to see in the global equity markets in the next 12 months. Duncan, could we start with you on this particular topic?
Sure. Whether my answer will be the most insightful, I doubt it. But look, I guess I'm not the person looking at global equity portfolios day in, day out. As trustee, we've got a multitude of things to be thinking about at any given point. So I think global equities will always continue to make up a meaningful part. Kind of 18% that you quoted earlier is still a meaningful part of the overall portfolio, right? So I think global equities will continue to make up a meaningful part of the portfolio. And so it's about making sure that risk is, as I said earlier, just kind of right-sized relative to all the other risks that you're facing at that point. What's going to happen to equities? Well, who knows? And that's the beauty of the kind of right size bit. That's the beauty of employing people like Anthony, like Neil, etc., to do that really hard thinking, picking the right people. Neil spoke about kind of cultural alignment and kind of how it's embedded within the organization. I think you want to be working with the right partners to help you manage these risks. My best guess is that it's going to continue to be a rocky ride, but I don't think that's particularly insightful.
Okay, thank you, Duncan. Neil Mason, final word from you on the future.
The future. Well, I talked to Duncan's earlier part. I think it's a little bit of a mystery from our point of view. We have the local government system works, so we have a completely new pensions fund committee. I have absolutely no idea what their aspiration will be. We'll support them as officers, but it may be our attitude to risk is completely different. So we have to be prepared for that. As the sort of outcome, the long-term look, I think with the stimulus in economies at the moment, we should continue to see good returns in equities. I certainly hope so, because we've got a valuation next year.
Thank you, Neil. Anthony, probably next 12 months, what do you expect to see global equities?
I've got absolutely no idea, no insight whatsoever what's going to happen, especially take us 12 months or the next 3 years, 5 years. I think what I'm trying to do is, and I try to do that with my team, is trying to look at very long term. How is the world going to change in 5 to 10 years? And we try and stick to that. And obviously we were at the wrong side of the fence last year with the COVID pandemic, but we stuck to our guns and we came out of it, I think, a lot stronger. I would say that the two primary risks that I currently see into markets, and something we'll closely follow on, is obviously COVID is still with us, and any potential mutation to that virus that might cause, might render current vaccines ineffective, will derail a lot of things in the short term. And obviously the other one is the counter argument to that. If COVID does slowly dissipate, which is everyone's hope, you get that inflation risk, you get that economic growth, which I completely agree with Neil's earlier point that it's a good thing. Let's not get over it in terms of it's a bad thing, inflation is a bad thing. I think we need to see a pickup in economic growth. I think it's good for economies and wages, as Neil kind of mentioned. But I think that's the kind of two main key risks. If inflation continues and is more sustainable than we think, it's not transitory, this will affect valuations, and especially valuations in kind of the higher growth areas potentially. So I think that's the two primary risks that I'm seeing in terms of markets.
Thank you, Anthony. And Peter, what about you? What are you expecting? What are you telling your clients when they ask you what's going to happen?
I am going to unfortunately give you a little bit of a consultant's answer here, which is to sort of give you both sides. There's clearly a lot of headwinds for equity markets, so that possibility of rising inflation, rising interest rates, what that might do in an economy where we've seen a lot of house price inflation, a lot of people taking out mortgages at very high levels. There's also the unwinding of these government support schemes, so the fiscal spending that's kind of characterised the last 18 months to sort of be taken down, and firms being asked to stand on their own 2 feet again. And then, of course, as Anthony said, the threat of continued disruption from COVID-19 in the future. Those are the headwinds. If inflation doesn't pick up to the degree that some market participants fear that it might do, if the government doesn't sort of turn the taps off too early in terms of the support they provide, and if there is this sort of consumer-driven economic recovery and firms can really benefit from that, we might see earnings growing at sufficient pace to keep valuations on track. Just to sort of add a final bit to Duncan's point, pension schemes obviously do benefit from this longer-term perspective, and so they size their equity allocations in accordance to the level of risk they're willing to take. The schemes that I have where they're looking at perhaps transacting with an insurer in the shorter term future, they've got a shorter time horizon, I'd be talking to them about thinking very carefully about whether the level of equity risk that they have remains appropriate if their time horizon is only the next 3 to 5 years.
Okay, thank you, Peter. Thank you. And the final word of the discussion goes to Neil Godin. Neil, what are you expecting to see in equity markets over the next 12 months?
No pressure there then, Mark, thanks. I mean, I hate 12 months. It's a horribly short-term view on the world, which is very difficult to call. Having just done the work yesterday, though, to look at returns since 1970 on a yearly basis for the S&P 500, there's about an 80% chance that returns are positive. So I can give you that answer with absolutely no certainty, but sort of 12 months, you know, black or red at the casino largely is what we're going for. I do see inflation as a risk, and I do agree with everyone who said that some inflation is not a bad thing. It's obviously too much inflation, then we do get into the situation where that could be really painful for equity markets. I did see a headline today that made me chuckle. UK inflation surges to 2.1%. That sounds more like a tax trickling than a surge to me, but you know, I'm certainly not an expert and I don't know where it's going to go. So yeah, I mean, this often gets called the most hated bull market of all time, and the chances are it carries on being the most hated bull market of all time. Interest rates don't go up materially and we bumble along and we look back in 5 years and you were right just to hold equities, you were right to carry on holding good companies, good opportunities, find the value where you can. That may be in all sorts of different stocks, but it probably carries on much the way it has before. You know, COVID probably slowly peters out. You know, I'm generally quite a positive person, so I think there's a good chance we have another good year of equities.
Thank you. Then that's a very good point to end on. Thank you very much, Neil. Thank you very much to all of you for sharing your views and this discussion. Thank you. It's been great. I'd also like to give special thanks to Artemis for making this digital roundtable happen. So thank you guys. Goodbye.
Thank you very much. Cheers, Mark.
Thank you.
Nice to meet you all.
Cheers.
Thank you.